Thank you all for joining us. Always a great pleasure to have you for our quarterly economic updates. My name is Louis-Philippe Champagne. I'm the Associate Vice President for Public Affairs and Industry Practices at the CCA. And I am joined today with my colleague, Yoonghang Liu, who goes by Max. Max is our economist at CCA, and he is the author of our quarterly economic update. This is our fall edition, or fourth and last report of the year. The next one will come in very early 2026. Max is coming to us with a significant insight this morning at a time that is, I think we can say, fairly unique for our economy and for our trade especially. As all of you know, the last year have been quite challenging for Canada and all trading partners to the US. We are faced with a number of crises in terms of our workforce, in terms of our housing affordability, and our supply chain and construction. We have significant concern, and so does our member. This report look at a number of these indicators. Max spent most of the last 3 months looking at a number of numbers from the Bank of Canada, from Statistics Canada, and so on, to paint a better pictures of where we are economically as an industry and the key takeaway that you should know as executive and construction leader across the country. So without further ado, I'll turn the mic to my colleague Max to go through the update, and then we'll take some questions at the very end. Thank you all again for joining us today. Max, the floor is yours.
Okay, thank you, LP. So hi everyone. It's only my second report, and again, I look forward to discussing with all of you as we go through today's presentation. We'll walk through how our economic sectoral, labor and cost indicators have changed since the last report, and as well as the latest updates on trade disputes since the start of March. So how's the Canadian economy doing? Well, it has seen better days. The economy contracted by negative 1.6% annualized in Q2 from Q1. We have not seen contraction of this magnitude in a quarter since the start of COVID. And unlike many previous quarters, when we saw negative growth, it's not expected to bounce back immediately in the next quarter. Most projections are fairly close to zero. In the first quarter, US firms reportedly stockpiled Canadian goods, which had a pull forward effect in exports. However, that temporary boost wasn't enough to offset the decreases in the second quarter. Merchandise trade deficit widened by 27% over the first half of the year compared to 2024, with the largest declines being in exports of industrial machinery, equipment, and parts. Consumption remained resilient, contributing 3.5 percentage points to GDP growth in Q2. However, GDP in the first half of 2025 is still net positive compared to 2024. That warning signs have emerged. Even though domestic demand didn't show signs of slowing in Q2, the unemployment rate remains elevated and is expected to take a toll on domestic demand in the coming months. Gross fixed capital formation, which is investment activities, has slowed, sliding by 1.2% in Q1 from Q4 2024, then dropped by another 0.1% in Q2 from Q1. The slowdown signals lingering uncertainty among both businesses and households. One bright spot was investment in residential construction, which grew by 1.5% in the second quarter, driven largely by developments in British Columbia. There was a surge in apartment permits issued in the first quarter, and many of those projects started in the second. Turn our sight over to monetary policy. As most of you are probably aware, the Bank of Canada made a cut of 25 basis points back in September. This is the same chart that I showed you last quarter, and for a quick recap, the slide shows a dashboard of what central bank looks at when reviewing the economy. The purple line is core inflation. It represents year-over-year change in core CPI, excluding price volatile items such as food and energy. The red dotted line is unemployment to job vacancy ratio, which is an indication of how easy is it to hire in the current market or get hired for those looking for a job. The goal is to keep both indices low at the same time, and the central bank makes trade-offs between the two. But as we can see, both series has been trending higher ever since the trade dispute. So let's first explain why the bank has decided to cut rates again. The key factor here is the removal of the counter tariffs, which effectively removed a major risk of for inflation and changed the fundamentals of economic conditions. The Bank of Canada also predicts that rising unemployment rate will curb inflation in months to come. Again, these are the two most important indicators of the economy, and neither has improved during the past 12 months. Bank of Canada's next meeting will take place tomorrow. Governor Tiff Macklem has recently stated that he's hoping the central bank can be a bit more forward-looking. Given the current conditions we discussed, the governor is basically saying we should ignore the near 3% core inflation we're seeing currently and cut rates to support jobs. The bank views the deterioration of labor market as the bigger threat to stability of the Canadian economy than high inflation, and most economists agree. Last week, we got another report from the Monetary Policy Council at CD Howe Institute. More than half of industry and academic economists support one more cut of 25 basis points tomorrow and ending the easing cycle there. Real GDP of the construction sector has remained relatively stable over the past 3 years. In the second quarter of 2025, it grew by 0.24% in chain dollars, reaching 167 billion. Statistics Canada has made a minor revision to the value in Q1, changing the previous growth rate from 0.26% to a negative 0.01%. Although this has effectively delayed the speed of the industry's growth by a quarter, the scale of the revision itself is small, and a production-based GDP level growth rate has long been close to zero on a quarterly basis. Nevertheless, growth in construction is 0.41 percentage points higher than all industry growth in Q2, which declined by 0.17% year over year. Construction grew by 1.56%, while all industry grew by 1.08%. Looking at the subsectors, the biggest contributor was residential building construction, accounting for 0.6 percentage points of the 0.24% increase. Residential building construction itself is up 5.1% over the past quarter and up by 1.8% year over year. Engineering construction activities saw a quarterly decline by 0.8%, contributing negative 0.3 percentage points to the total change in construction. Engineering construction has experienced consecutive declines since the start of the year, contracting by 1.6%. As the chart shows, most bars are covered either in green or blue, so either engineering construction or residential construction. And historically, these two subsectors explain most of the variations in total industry GDP. Investment in Q2 contracted by 1.2% from Q1, then recovered by 0.6% in Q3, which is now 63.6 billion. These are investments in buildings only. And investment remains 4.9% higher year over year. Most of the gains made in Q1 were sustained. As the chart shows, investment in construction, particularly residential construction, is very sensitive to changes in the Bank of Canada's target rate. When rates were on the rise from Q3 2022 to Q2 2023, investment in single and multiple dwelling buildings quickly reacted. You can see these bars over these quarters are all negative. When rates started to lower in Q4 2024, investment in multiple dwelling construction began to rise. Typically, we observe impact of rate changes on investment within 3 to 6 months. The largest driver of Q2 decline was a single dwelling building construction, accounting for 0.7 percentage points of the 1.1% decrease. This is a 2.3% decrease over its own value in the first quarter and a 1.1% decrease from a year ago. That was reversed in July and August. The bright green area we see at the end here represents a 4.6% quarterly gain. So provincially, 9 out of 13 provinces and territories recorded increases in investment in Q2 compared to the first quarter. However, a few regions moved in the opposite direction. Newfoundland and Labrador continued to decline, down by 14% after a 39% decline in Q1. Alberta saw a dip of negative 4%. In contrast, investment in British Columbia edged up by 6.7%, and Manitoba is up by 11%. Now, investment is the work already put in place, but by the time I'm writing the report, I can only rely on the Q2 data. It has less to say about what's happening now and in the near future. So we created this new chart, and some of you have seen this already from the regional coup calls, but let me introduce you to it again. The line in orange represents the level of building permits in dollar amount, and the dotted line in light gray marks what the quarterly change is for all types of buildings. Lastly, the stacked bars showed contribution to quarterly change. The value of permits approved in Q2 sits at $34.3 billion, down 6.3% from the first quarter. This chart includes, in addition to the Q2 data in the published report, a Q3 estimate based on July and August values. It's reaching some of the lowest levels we've seen in recent years. Most of the decline, both in Q2 and Q3, come from drastic drop in multiple dwelling residential building construction, contributing 8.4 percentage points to the total decline in Q2, then a further 1% decline in Q3. Compared to itself, multi-residential permits was down 19% in Q2. Single dwelling permits continue to slide as well. Regionally, the biggest contributor to that slide was British Columbia in Q2, accounting for 5.7 percentage points of the total decline, which is 30% less than its own value in Q1. Large decreases are also seen in New Brunswick and Saskatchewan, down 30% and 22% respectively. The only two provinces that are still at historically high levels are Alberta and Nova Scotia. And even those two provinces, the change since the first quarter has been negative. The only positive driver in Q2 was governmental and institutional permits. Then everything else became negative in July and August. We should note that this is not the result of the federal push to build Canada yet, but driven by a one-time surge in May. A $1.6 billion mega permit was issued to a new hospital in the Niagara CMA. Thus, the reverse happened in the third quarter. Overall, we're seeing broad decreases in all types of permits except institutional buildings. As for the reason why we're seeing these declines in multiple residential permits, I don't have a good chart to show, but I'm sure you're all aware of the crash in the pre-sales markets in Metro Vancouver and Greater Toronto area. That's making it more difficult to finance apartment builds. They're leading to project cancellations and thus fewer intentions to build as well. The lowered interest rate will have a positive effect, but that alone is likely to be insufficient in driving permits value up. It could take longer for market confidence to recover. The Prime Minister has made several public statements in the last 3 months. He often highlights that Canada currently has the best trade deal with the US, and the US application of CUSMA keeps average tariff rate on Canadian goods among the lowest of its trading partners. In recent weeks, I've heard from members and stakeholders asking where things stand today and what trade policies like CUSMA means for the construction industry. While the Prime Minister's remarks is true in some sense, it's important to ask, how true are they for construction? That's what we're discussing in this quarterly focus. The construction industry relies on imported materials and exports very little, which makes it especially sensitive to import disruptions. So I'm going to do a recap on Canada's recent measures. Back in March, the federal government imposed a 25% tariff on nearly $60 billion worth of goods in response to US tariffs. It was rolled out in two phases. The first 30 billion on March 4th, and then the second on March 23rd, which added more items, including steel, aluminum. What's important here is that these tariffs apply even if the imported goods are CUSMA compliant. Now, CUSMA compliance simply means importers can claim tariff preferences with a certification of origin. Product-specific rules are set mostly at the HS8 level, that's the harmonized system codes, and enforced by each country's customs. So when a shipment arrives at the Canadian custom, if the importer could prove it was majority made in North America, the tariff rate should be 0. However, that was not the case with the new Canadian tariffs, which are filed under a different schedule. Then, as we moved into mid-2025, things got more complicated. On June 27th, Canada introduced the tariff rate quota, or TRQ, on steel imports. At first, it only applied to countries without a free trade agreement, or FTA, with Canada. Imports above 2024 levels faced a 50% tariff. A month later, on July 31st, a 25% tariff was added on steel and aluminum poured and melted in China. And the next day, August 1st, the TRQ was extended to all countries with different quota levels for the free trade agreement partners and non-free trade agreement partners. Even the FTA partners now pay a 50% tariff on volumes above the 2024 levels, and quotas on non-FTA countries has been further lowered to 50% of 2024 levels. Lastly, on September 1st, most countermeasures on the US were rolled back, except for tariff on steel, aluminum, and autos. So that was a lot. And after the September 1st rollback, most construction inputs in terms of items and categories enter Canada free of additional tariffs. But what's still in place? Well, we can separate them into 3 bins. First, with the US, a 25% countermeasure still applies to steel and aluminum. These measures apply even when goods would otherwise be CUSMA eligible, and 25% surtax on auto. Second, with China, a 25% surtax on steel and aluminum also that are melted and poured in China, regardless of whether it was later fabricated somewhere else. In addition, volumes above half of 2024 levels are charged with a 50% tariff. Canada also maintains a 100% surtax on Chinese-made EVs, but that will likely be rolled back soon. The third bin, with the rest of the world, Canada now runs a steel tariff rate quota across every country, except for US and Mexico. Imports above quota face a 50% surtax. There's also one more development. From November, federal procurement will prioritize Canadian source steel and softwood lumber for federal construction projects, mirroring the Build America, Buy America Act in the US. Projects can apply for exemptions, of course, but they will have to go through a lengthy process to prove they cannot find any Canadian alternatives. So although there were rollbacks, key measures on steel and aluminum not only remain in place, but have increased and expanded in scope. Then we have the legacy CEMA duties on rebars and other steel products too. On top of that, the new procurement restrictions. And why does this matter? Because steel is a primary intermediate input in construction. And how big is that? In 2023, the industry spent about $22 billion on architectural and structural metals alone. That is roughly 13% of all manufactured input costs and is the single largest category. Add the steel heavy items, cutlery, hand tools at about 5%, nuts and bolts and screws at 2%, shipping containers, boilers, and tanks, another 2%, and other steel product manufactured from purchased steel, which is a separate category accounting for a further 2%. Together, steel and steel-intensive inputs account for about 24% of all manufactured inputs used in construction. As an industry, we also have a high import exposure. About 24% of the sector's intermediate inputs are imported. That's both goods and services. In dollar terms, that is roughly $60 billion out of a total of $253 billion, with about 15% of those imports coming from the US. Having cheap and reliable domestic supply is, of course, desirable, but existing capacity gaps will not go away tomorrow. Canada has limited domestic supply for many inputs and virtually none for critical items like white filling beams, float glass, and ceramic tile. On steel, most large domestic mills we see on the news, including the likes of Algoma, focus on flat products suited for making car doors and not structural sections, beams or rebars. Even categories where domestic supply exists, geography creates a natural barrier. Shipping long products to Vancouver from Canadian mills can cost 3 to 10 times more than sourcing from mills just across the border. All these policies raise the delivered cost of steel products directly through surtaxes and quotas and indirectly through procurement restrictions and logistics. Restricting imports and usage narrows supply options, reduces the number of projects that Canada can afford. With the budget next week and deficit concerns front of mind, added red tape and sourcing constraints push up cost rather than bring them down. Moving on to the third segment of today's presentation, I'll discuss recent changes in business sentiments, what obstacles builders are expecting in the near future. Results from the Q3 Canadian survey on business conditions tells us that expectations have slightly improved. 20% of all firms reported that they do not expect any significant obstacles in Q3. That's 6.7 percentage points more firms than in Q2. Among the top 10 obstacles identified, 4 are cost-related and 3 are labor-related, both seeing around 3.5 percentage points fewer firms reporting that they're expecting these obstacles. Inflation remains the most cited concern with little improvement. And compared to Q2, concerns over insurance costs declined by 7.1%, moving this issue from second place in the last quarter to the third place. Concerns about recruiting skilled employees is also down by 2.7 percentage points and at the second place. Input costs ranked fourth, down by 6.4 percentage points. The fastest rising concern in the top 10 is insufficient demand for goods or services offered, which is up by 3.1 percentage points. It remains relatively low overall, with 22% of businesses reporting insufficient demand for goods or services offered as a concern. However, this does point to the decline in permit levels that we discussed earlier. Regional differences are also notable. Businesses are most optimistic in New Brunswick and Nova Scotia, while more pessimistic in British Columbia and Newfoundland, Labrador. The StatCan survey from last slide was conducted in July, and a lot has changed since then. Some positive, some negative, including the rollback of the broader countermeasures. To get a fresher read, we'll look at the business barometer from the Canadian Federation of Independent Businesses. Higher values here means stronger confidence over the next 12 months, and 50 is the neutral line. So as we enter territory below 50, that means small businesses are more pessimistic than optimistic. In July, when the CSBC results came out, confidence briefly rose above 50% for construction and for all businesses, one of the only times since March. Since then, it has dropped considerably. As of this month, the overall index is about 4 points below 50, and construction is roughly 7 points below. We're still above levels from March through May, but sentiments are moving quickly. And these results are more in line with the rest of our report, where we saw softer permits, less vacancies, and higher delivery cost. So how's low confidence reflected in labor markets? Average construction employment in Q3 is down 0.6% from Q2 and down 1.1% from Q1. It remains 1.6% higher than in Q3 2024. And before I dig into each province, I just want to clarify that the numbers you see here are based on all 3 months in Q3, whereas the published report was completed earlier and based on July and August. In the labor force survey, Alberta drove most of the quarterly dip. Jobs fell 8% quarterly after a drop in July that did not rebound in August and September. Year over year, Alberta is still about 2.5% higher and remains a leader in new builds and labor demand. 8 out of all 13 provinces and territories posted gains. In Newfoundland and Labrador, employment rose 4.1%, reversing the Q2 softness. PEI was little changed in July and August, but down by a lot in September. Nova Scotia gained 4.5% and New Brunswick 3.5%, making the Atlantic region a growth leader in terms of employment force. And Quebec recovered 1.3% from Q2, but is still below last year's levels. Ontario remains elevated versus 2024, with a less than 1% increase in this quarter. Saskatchewan held most of its Q2 gains. Manitoba pulled back by 1.8%, but is still up year over year. British Columbia remains firm with steady gains since last year. In Yukon, employment rose by about 400 from last quarter to roughly 3,000, a 16% increase. So at the CCA, we've been using StatsCan's Labor Force Survey as our primary employment source. It's the headline monthly survey. It's what you see reported most frequently on the news. The Labor Force Survey counts the number of people working in construction, including those who are self-employed, adding up to 1.6 million roughly. StatsCan also publishes the survey of employment, payrolls and hours, or CEF for short. This survey also provides us with a variable named employment, but it's only about 1.2 million. The numbers here are different because it counts the number of payroll jobs and not people. It also excludes those who are self-employed because they don't receive income on a payroll. So previously, when we said there was a notable dip in Alberta, that represented the change in all workers. And geography differs here too. The LFS is by place of residence, and the CEF is by where the jobs are located. It doesn't matter nationally, but it creates provincial differences. This chart represents the change in payroll jobs from CEF, both salaried and paid by the hour, so long as they receive their income from a payroll. Here we see that the change in Alberta is actually positive, but like the rest of Canada, these changes are marginal. Fluctuations are high in the territories, but less than 1% in the rest of the provinces. The Labor Force Survey is more up to date. Previous map we showed was constructed based on all 3 months in Q3, versus this one you see here only represents numbers from July. I am looking to include this chart in our report in the future as well. Construction job vacancy rate declined by 0.3 percentage points to 3.1% in Q2 compared to Q1. And you can see it was even lower in July. 38,000 vacancies were posted in the second quarter. It has really come down since the peak and is 6,600 positions fewer compared to Q2 last year. That's a negative 15% decrease. This is partly the gap being filled, and current employment size is pretty big. I know long-term labor shortage is anecdotal in the industry, but more recently, I do believe we're starting to see market dynamics changing. When you take into consideration the permits and other indicators we're seeing, especially right now, everyone agrees there's a housing crisis, there's an infrastructure deficit, a need to build major projects, but at the moment, this is another indicator that points to the fact, at least in the next 3 months, we won't see as much action as we're seeing discussion. Unemployment went up from around 100,000 in Q1 by 16% to 117,000 in Q2. That combined with the lower number of vacancies makes it easier to hire right now than ever since the pandemic. About 3 applicants for every vacant position, up from 2.4 in Q1. And in the Q&A session, I'm happy to discuss currently what you believe to be the more specific issues when it comes to labor shortage. And based on the high level numbers alone, it doesn't seem to be applied broadly. Last but not least, let's take a look at recent developments in costs. Regionally, 11 out of 15 CMA surveyed posted growth above 3%. London was the highest once again with a 6.6% increase. That's down slightly from 7.1% in the Q1, but it's a consecutive increase. And in Q2, that's followed by Quebec City, which rose 6.4% from 3.5% in Q1. In both regions, growth were driven primarily by the increase of 10% or more in structural steel divisions. At the other end of the spectrum, 3 lowest rising CMAs continues to be Halifax, St. John's, and Ottawa. Costs have increased across all building types, while rankings among them have remained consistent. High-rise apartments continue to experience the slowest cost growth, up by 2.7% in Q2, whereas low-rise apartments saw 4.2% increase. The non-residential composite rose by 4% in Q2. Within this category, factory buildings recorded the highest increase at 4.8%, followed by the bus depots at 4.5%. Cost increases for other building types remain close to the overall 4% average. The biggest contributors to composite change by master format divisions are metal fabrications and concrete. Metal fabrications increased by 5.5% year over year. That was 4.1% in Q1, while concrete is up 3.1%, which was 3.2% in Q1. Structural steel also rose by 5.9%, which was 3.1% in Q1. And this chart is ranked by the increase of the divisions in Q2. So as you can see on the left here, structural steel framing is one of the highest increasing divisions alongside with metal fabrications. In the other index that we've been tracking, the IPPI, you will see that ferrous metals remain low. The IPPI is calculated based on Canadian producer quotes. It's the price that Canadian producers are selling at. And if you go to Algoma, they have lots of sheet metal coils in oversupply that are not being sold to the US, but the BCPI reflects more what contractors are charging after buying the steel products that they needed. Conveying equipment has low weights in the index, but the division itself is up by 8.4% in Q2, following a 7.4% recorded in Q1. Steel is a primary material driving cost increases across most construction divisions. Impact from the already implemented TRQ, the upcoming procurement restrictions coming in November have not yet been reflected in the numbers you see here. Costs have already risen significantly, doubling, the increase in CPI, and there is growing concern that these measures will have an even greater effect than the counter tariffs on the US earlier this year. So what's ahead for the industry? In terms of risks and challenges, we have cost of steel products going up, soft apartment pre-sales, stalling the planning of new multi-residential projects, and procurement restrictions making it more difficult to work federal contracts. But to end on a more positive note, we also have the federal spending, lower interest rate, and fast-tracked approvals to look forward to. Though while I'm saying that, I've realized everything that you're seeing here on the right side are all government related. That concludes our presentation for today, and I'm happy to take any questions.
Max, thank you as always for your insight and analysis. Very much appreciate this, and I'm sure people as well. A few housekeeping items before we turn to question. We have about 20 minutes to ask Q&As. I want to remind people that this is recorded, so if you don't want to speak up or come on camera, you can use the chat function to convey your question, and Max and I will moderate those. As well, for my colleague from Quebec, si vous voulez poser des questions en français, ça va me faire plaisir de répondre ou de assurer la traduction avec Max. So thank you for this. Max, I'll let you take some questions.
Hi, Mike.
Max,
Go
good
ahead.
morning. How are you?
Good.
Hey, so I got a bunch of questions I'll ask, but I could limit to two that are philosophical. So is Adam Smith dead forever? Did Ronald Reagan not know what he was talking about forever? And the federal budget that's coming down, have they separated operating from capital, because the size of the deficit is likely to be so scary that it will have a tremendously negative rollover effect on capital markets and other issues?
Okay, so your first two questions, I'm less suited to comment about Adam Smith and Ronald Reagan. But like overall activities in the private market, not just for construction, is not as lively, let's just say, as in the public sector, and that is true in most countries around the world. Secondly, we will have something written published next week after the budget announcement. I will be there to look at it myself. I'll be in the lockup, see it a few hours before the table becomes public. But although a lot of people question the separation between the operational budget and the capital investment budget, there's also some good reasons to it. For one, capital investment could usually get like a federal debt that's more long term rather than short term. So separating that, I think, will help the federal government in securing that the right form of debt for the right form of projects. But of course, in terms of the definitions, when it comes to what counts as a capital investment, there are some discussions on that currently. And one other point I want to mention is I think a lot of the deficit not only comes from increased government spending, but also projected declines in revenue. And why does the revenue decline? Well, a few things. The federal government made a tax cut of 1%, which a lot of people aren't actually aware of. So if you're receiving a salary on the lowest bracket, you now only pay 14% tax on that instead of 15. And the other issue is slowing GDP growth. So that's something I guess the federal government really tries to prevent. They want to keep economic growth on track and potentially just to be more positive than not, potentially these investments could bring up our GDP growth, right?
Thank you, Max. I'll briefly add as well on the budget that this is the first budget of this government, the first budget of a new administration when it comes to the Prime Minister's office. It's the first budget in over 10 years that is not presented under Justin Trudeau. So I think a lot of the presentation and structure will be first and foremost political. To answer your question, Mike, specifically, the idea of separating operational costs from capital investment was announced in the election first and foremost, and I think was first and foremost a political decision to try to identify himself as an economic prime minister. Now, action will speak louder than words when come November 4th, as we look at these actual numbers and the size of deficit and what it actually means on both sides of the equation. What we already see in terms of operation is a reduction of the size of the public service and a numbers of cuts in terms of programs and investment in especially the social sector. Will this match in terms of capital investment, and how will the bottom line look like? We'll know very soon. Max, I'll turn your attention to the chat. We have a few questions here from Katie Kent. One specifically on shifting production to the US, as we see in the auto sector, and how other industries can be leveraged to fill the employment gap.
Right. I think, again, I might be less suited to comment on these, as here we're the Canadian Construction Association, but I do have some thoughts, hopefully not too controversial. So regarding shifting production, the auto industry is it's a particular one in the sense that the supply chain is spread it out across the two sides of the border, and it's said that a car goes back and forth between borders like 7 to 8 times before it's actually manufactured. And what's driving these production to the US is that US has the bigger market, and we've talked about what the role that CUSMA exemptions plays in the current trade situation. While the US accepts most Canadian products with the CUSMA preference, meaning if you could prove it's produced in Canada, they won't charge you a tariff. The details surrounding autos is more nuanced, and that's causing a lot of the shiftings. And for construction, I wouldn't say it's one of the biggest concerns we have. As we said, that there are many more in terms of permits, in terms of immediate increase in the potential price of steel products. And to your second question, what new industries can Canada explore? That is a difficult one, and I will leave that to someone else to answer.
Maybe I can step into, maybe not directly answer a question from an economic standpoint, but from a construction reality standpoint. One thing we've been discussing extensively in recent months is the challenge of our international supply chain, and the desire from Canadian government and all government in Canada really to focus more on Canadian manufactured product. One of the challenge, or two of the challenge that Max highlighted, is the regionality of it, of course, and the availability of some of these material. But there is a once in a lifetime chance for Canada now to look at domestic manufacturing. The big question is, what will the US trade relation evolve in the next few months and years. If things goes back to normal, which I don't think will happen overnight, the need to diversify our supply chain is much less present. But if this protectionist agenda persists beyond the midterms into the next administration in the US as a new way of doing business for America, we will need to seriously look at how we transform our own supply chain. A great example Max mentioned earlier is float glass and glass production in general. We used to have 2 float glass manufacturing plants in Canada. Now we have 0. So despite the fact that we have extensive natural resource and silica deposit, we cannot manufacture our own glass in Canada. We are entirely dependent to the US and Mexican market when it comes to the entrance to any kind of fenestration product we have. This is significant because if you build any kind of high rise, if you build any kind of homes or buildings really, you will need some glasses in the project. So this is, as one of the manufacturers was telling me last week, it is almost a national security concern, the fact that we have no control on that supply chain. I believe there's an opportunity for a number of industry to expand in terms of building more Canadian product.
And to your last question, to your third question, regarding the additional 10% tariffs, to the extent of my knowledge, I could be wrong, but I think that only exists in the form of tweets on Truth Social. I don't believe it has been enforced. Whether it will get worse or better, you know, like life finds a way, markets finds a way, will always adjust after every shock. Obviously, everything would have been better without any of these political disruptions, trade disruptions. But, you know, so going back, that 10% tariff, I don't believe that's been materialized, and it's, you know, not an immediate concern yet. Okay, you have 2 more messages here.
Just want to check on Mike, who's back on screen here. You had another question?
Yeah, LP, to follow up on what you just indicated, has there been any good research done related to the economics of a more full supply chain capability in Canada? Because, I mean, under free trade, right, it was always cheaper just to ship the whatever to the whatever, and you have a big factory, and so your cost is probably 1% better than it would be somewhere else. And in the face of nothing else, you should actually pursue that. But in a world of political risk like we've not seen, is there much that, you know, you could actually do a Canadian supply chain maybe 5% more expensive on a perfect non-risk political world, but when you do a proper, fully adjusted risk assessment, you say, right, it makes sense for Canada to start intervening in the supply chain before it all goes as raw materials to the rest of the world. Anyways, just to follow up to what you said, actually.
It's a very complex political, macroeconomic political question there, because fundamentally, you're right on this, Mike. Country have competitive advantage on specific production, right? And that would always be the case. The lowest price, the most efficient, most productive market is a free trade market, and CC has been strong proponent of that with the government. The moment government decide to be protectionist or put in place protectionist policy for political reason, whether it is what followed the election of Donald Trump, the Canadian response, China's reality, etc., then you put artificial market condition around this productivity. Then the question becomes, what's the end goal? If the end goal is Canadian prosperity and making sure economy is resilient and making sure we create jobs, then are we trying to phase away from our relationship with the U.S. to be less dependent? I think most Canadians would agree right now this is important to do, just because of the uncertainty that comes from the U.S. We need to be more independent. For a long time, our industry was asked diversify to other market. Look at the Asian market, look at Europe, look at other international partners that are not the US, look at Mexico, and now we can circumvent the US and the North American market. This has since changed over the summer, where the rhetoric we've heard from the government, the federal government, has been more of a let's buy Canadian as opposed to let's not buy American. This is a profound shift from diversifying international trade to our own protectionist measure. those have pros and cons, right? And what we see right now is a federal government that is very supportive of the auto sector, of the steel industry, of lumber, which are important sector with important job. But in doing so, somebody has to take the bill. When you say we're only going to buy Canadian steel, artificially that price will go up at the benefits of steel worker, but more importantly, steel companies. But then somebody have to pay for this, and that somebody is most likely taxpayer through municipal project and government project that will increase in price. So it's a catch-22, right? One way you want to support your economy, but you're going to damage some part of it.
And just to add to that, I do believe one of the challenges that Canada faces in this trade war is that the US has a much larger market than Canada. So, sometimes you might see like Canadian business, like again, with the certain businesses moving to the US because the US market is bigger. Is the Canadian market large enough to sustain certain manufacturing like factories? That's always going to be another challenge. And in the chats, two other questions that Kathy had. One on whether the real estate drop will stall construction in other building types. I wouldn't say they are directly related, but all of them are affected by the same broader impact from uncertainty, from trade conditions, from delivery cost. So yeah. And do you think CUSMA negotiation will CUSMA be terminated or replaced with this? That again is more political, and you can hear different thoughts on that, but in the end, it kind of comes down to like what people present at the negotiating table, right? And how Donald Trump feels on that day. And well, I do think a lot of people are concerned with whether CUSMA or something like it could still stay in place. It is another opportunity. So as Donald Trump has said, well, he's terminating trade talks again. He said that once before. He was back on the table, back at the table. He'll be back again. But if not, this is another, opportunity to actually renegotiate all trade conditions and not just CUSMA.
On CUSMA, for those specifically interested in a negotiation, what's happening? The federal government is currently conducting a consultation phase with industry. The deadline for submission is on Monday. CCA will be submitting on behalf of the industry a lengthy proposal that we've got as feedback from our members and our association across the country. If you're interested to read more, it's going to be on our website starting next week. And of course, reach out to me and Max if you want to discuss. We'll always be happy to talk to you about this. I see we have just a few minutes left. So if there's any final question, now would be the time to unmute and ask them. Otherwise, you can always put this in chat. We'll be happy to entertain maybe one last question. And if I hear none, looks quiet, I think we'll be good to wrap this up. So Max, thanks again for your analysis and feedback in this quarterly economic update. We will be back in January with the next edition of the report. I'll remind you that the report is now public and will be distributed by email today. Please have a look at this on our website, share with your colleagues, and thank you all again for joining us for this quarterly economic update. Have a good day.